Welcome back to Wealth Signal. I'm Alex Carter, and what I'm about to share with you today could completely change the way you look at one of the hottest sectors in the market right now. Back in March and April, something strange happened in the stock market. Cybersecurity stocks, some of the most critical software companies on the planet, got absolutely crushed. We're talking 30, 40, even 50% drawdowns in just a few months. And the reason? People were convinced that artificial intelligence was going to make cybersecurity obsolete. Why pay for security software when AI could just handle everything for free? That logic turned out to be completely backwards. Because here's what the market missed. AI doesn't replace cybersecurity. AI needs cybersecurity to survive. You can build the most powerful AI model in the world, but if the data feeding that model isn't secure, it's useless. If the infrastructure running that model isn't protected, it's dangerous. Cybersecurity isn't a nice-to-have for AI. It's the foundation everything else is built on. And the market figured that out, fast. From April to June, cybersecurity stocks more than doubled. We're talking over 100% gains in under 2 months. Now, I know what you're thinking. Alex, why are you telling me about a sector that already ran up 100%? Did I miss the boat? That is exactly the question I spent serious time analyzing, and the answer is more nuanced than you might expect. Today, we're breaking down 3 specific names: Palo Alto Networks, CrowdStrike, and Datadog. And I'm going to show you exactly what the numbers say about where this sector goes from here. If you're serious about understanding where smart money is looking right now, hit that subscribe button and turn on notifications. I put out analysis like this every single day. Stock 1, Palo Alto Networks. Let's start with the big one. Palo Alto Networks, ticker PANW. This is the largest cybersecurity company by market cap. And if the name sounds familiar, it should. When enterprises think about building a serious security stack, Palo Alto is usually the first call they make. Here's what makes Palo Alto interesting right now. The company has been executing a strategy called Platformization. Instead of selling you one security tool, they're building a unified ecosystem. One platform that handles your network security, your cloud security, your AI security, all under one roof. Think of it like this. In the old days, you had to hire 5 different contractors to build a house. Palo Alto said, what if one contractor could do all of it, better and cheaper? That pitch is landing. Hard. The latest earnings confirmed it. Palo Alto delivered a beat and raise quarter, meaning they beat expectations and raised their guidance going forward. What's especially impressive is that analysts were worried platformization would hurt margins short-term because the company was offering incentives to pull customers in. But those concerns proved overblown. Revenue and profitability both came in stronger than expected. They're adding new clients, and the existing clients are buying more services. That's a double growth engine, and it's accelerating. Now here's where I want to be straight with you. Palo Alto isn't cheap. After the 100% plus rally, valuation is elevated relative to near-term earnings. You're essentially paying for a long-term thesis that this company will dominate the platform layer of enterprise security for the next decade. If you believe that thesis, the current price makes sense when you run it out 5 to 10 years. If you need this to work in 12 months, it's a riskier entry point. Technically, the stock has pulled back from its recent high and is consolidating around its 30-day moving average, which analysts see as a healthy pause, not a trend reversal. Drop a comment below. Have you been watching Palo Alto? I want to know where you're positioned in this sector. Stock 2, CrowdStrike. Now let's talk about CrowdStrike, ticker CRWD. If Palo Alto is the veteran building the fortress, CrowdStrike is the specialist who watches every single door. This is a cloud-native cybersecurity company, which means it was built from day one to operate in the cloud, not retrofitted from an older system. And that architecture matters more than most people realize. CrowdStrike's specialty is endpoint and identity security. Think of every laptop, every phone, every server in a company. Those are endpoints. And every employee login, every system access, every automated process, that's identity. CrowdStrike watches all of it in real time, using AI to detect threats before they become breaches. And here's why that's critical right now. As companies pour money into agentic AI systems that operate autonomously in the background, the amount of network traffic is exploding. More traffic means more attack surface. More attack surface means more demand for exactly what CrowdStrike does. The numbers are backing this up. CrowdStrike's business is accelerating, both sequentially and year over year. And they have one upcoming catalyst that's worth paying attention to, a stock split later this month. Splits don't change fundamentals. A pizza cut into 8 slices is still the same pizza. But they do tend to increase retail participation and sometimes institutional buying because the per-share price becomes more accessible. One thing to watch, splits occasionally cause short-term volatility as some holders take profits. That could create a temporary buying opportunity for patient investors. Now, an important nuance on Palo Alto versus CrowdStrike. These two companies move together. Their charts are almost mirror images of each other right now, which means owning both is essentially the same as owning one, just with double the exposure to the same risk. If you want cybersecurity, pick the one that fits your thesis. Palo Alto for the platform play, CrowdStrike for the cloud-native, AI-integrated security play, or, and I'll come back to this, consider the ETF. If this breakdown is helping you think through the sector, smash that like button. It genuinely helps this channel reach more people who need this kind of analysis. And now, the third name, the one that's a little different, and in some ways the most interesting for the AI era. Datadog, ticker DDOG. If you haven't heard of Datadog, here's the simplest way to explain it. Datadog watches the watchers. While Palo Alto and CrowdStrike are focused on keeping threats out, Datadog is focused on observability, monitoring your entire cloud infrastructure, your AI models, your agentic processes, and finding problems before they happen. Think about what that means in practical terms. A company runs 50 AI agents simultaneously, each making thousands of micro-decisions per minute. Something goes wrong. How do you find it? Datadog is the answer. It's the system that tells you where the problem is, why it happened, and how to fix it, before your customers even notice. That's not a luxury. That's an operating requirement for any serious AI deployment in 2026. What makes Datadog's position compelling is the depth of its customer relationships. More than 50% of Fortune 500 companies use Datadog. That's not just market penetration, that's entrenchment. These customers have built their entire monitoring infrastructure around Datadog's platform. Switching costs are enormous. And now that Datadog has expanded beyond monitoring into a full security observability ecosystem, they're not just an add-on anymore. They're a core layer of the modern software stack. The business is accelerating both sequentially and year over year. Analysts are lifting price targets, and the MACD on the weekly chart shows a strong convergence, the technical equivalent of momentum building for another leg higher. The honest challenge with all three of these names, and I want to be upfront about this, is valuation. Right now, the stock prices for Palo Alto, CrowdStrike, and Datadog are all sitting near consensus analyst targets, which means the market has already priced in a lot of the good news. The upside case depends on one of two things. Analysts revise their targets higher as growth continues to accelerate, or the stocks consolidate here while earnings catch up to the price. Both of those scenarios have played out in this sector before. The question is timing, and timing is something nobody gets right every time. So let me pull this together and give you a clear framework for thinking about the cybersecurity sector right now. Because the real question isn't, did I miss it? The real question is,
Do I understand the long-term story well enough to hold through the volatility?
Here's what I think the data is telling us. This isn't a sector that ran up because of hype. It ran up because the market finally connected two dots that should have been obvious. AI growth and cybersecurity demand are not in competition. They're in direct proportion. Every dollar invested in AI infrastructure is a dollar that needs cybersecurity protection. Data center capacity is expected to double, and then double again over the next several years. That's not a short-term trend. That's a structural shift in how the global economy operates. So, how should a long-term investor think about this? Option 1. If you believe in individual companies and want to do your own analysis, Palo Alto is the platform consolidator, CrowdStrike is the AI native endpoint specialist, Datadog is the picks and shovels play on observability. Each has a distinct role. Don't overlap them unnecessarily. Option 2. If you want exposure to the sector without picking individual winners, the CIBR Cybersecurity ETF holds most of these names and has the same structural tailwinds. Less risk per name, less upside per name, but a cleaner entry into the thesis. Both are legitimate approaches. What's not legitimate is being on the sidelines because you're waiting for a crash back to April prices. If the thesis is right, those prices may not come back. One name that deliberately didn't make this list today is Zscaler. Their most recent earnings beat on the results, but the guidance showed a deceleration. On top of that, key members of their sales leadership left, creating a gap that could weigh on near-term revenue. While the stock is significantly cheaper relative to peers right now, cheaper can get cheaper when the fundamentals are pointing in the wrong direction. It might be a speculative play for high-risk tolerance investors. But for a long-term thesis built on accelerating growth, the other three names make a stronger case today.
If you found this breakdown useful, like this video. It tells the algorithm this is the kind of content worth showing to more investors. Subscribe with the bell on so you don't miss tomorrow's analysis. And drop a comment. Which of these 3 cybersecurity stocks do you find most compelling and why? I read every single comment. I'm Alex Carter, and I'll see you in the next one.